There's a really great interview by a gentleman named Russell Napier that was just published on Macro Voices. I'll post a link to it below. I just wanted to make a few comments on it. I think Russell's great. I've read his stuff for decades now. And this is an investment outlook that you will almost certainly not have heard from anybody else. To understand the world, you really need to look more broadly than what's happening in the US. The US is part of a larger machine. And at certain points, the things that are happening outside the US can be a major, major driver for what's going on here in the world. So the Bank of International Settlements, the BIS, is basically the central bank to all the central banks in the world. And they do interesting studies from time to time. They did a study that tried to understand when a country was at greater risk for a banking crisis. And they came up with two objectively measurable metrics. The first is the growth rate of debt relative to trend, more than 9% above trend. And the second of the metrics looks at the debt service ratio of the economy, also relative to trend. We're not going to dig in too much on all the calculation of the metrics and all that wonky stuff. Okay, we don't need to go dig too deeply into the details of those metrics. But I would like to say, I do personally find that approach persuasive. I think that's persuasive. And so let's talk about what the output of that was. There are 4 countries in the world that are flashing red on both metrics. Either one of those metrics creates a 50-50 chance of a systemic banking crisis within the next 3 years. And the 4 countries that are flashing red on both of those metrics are Hong Kong, Canada, China, and Turkey. Now, China is obviously the one that's most important in that group. They've got a very large share of GDP compared to the other ones. There's also a list of countries where there's only one of those metrics is flashing red. And that list is as follows: Japan, the Netherlands, Singapore, Chile, Thailand, Colombia, Saudi Arabia, and Indonesia. I really want to just focus on not the emerging market economies for a moment, but one, the Netherlands, right? European country. So that's one country in the Eurozone. But he also points out that there are 3 countries that are on amber, which is that they're almost on that list. Okay, and the last bit, that basically means they've got an almost 50-50 chance of a crisis. And those countries are France, Belgium, and Finland. So just looking at the Eurozone, there are 4 countries: the Netherlands, which is on that list that I read at first, and then 3 more that are almost on the list, which are France, Belgium, and Finland, that have an elevated likelihood of a banking crisis. Okay, so from one perspective, I've talked about this a little bit before, for the European Central Bank to create one interest rate, okay, that's what they do, right? They set the interest rate just like the Fed does here in the US. The ECB has to create one interest rate for 19 different countries, and potentially some number of them are going to be, if this prediction is right, in some form of banking crisis. So that is the difficult task for the ECB, which is always a difficult task for the ECB, in trying to deal with these economies that I say that this is always the biggest problem with the Eurozone, and why they're likely to go from crisis to crisis is because the economies are too localized, they're not unified enough, and therefore too difficult to use one interest rate in order to manage those economies. Okay, so that's a huge risk to mainland Europe. And it also suggests that in any of these countries that I just mentioned, if there is a banking crisis, the central banks there will be using extreme monetary policy. Now, the US is not on that list. The US is not flashing red on either of those metrics. Okay, so if we are not here in the US having a banking crisis, and one of the major economies outside the US is, that central bank will be using emergency policies And that will probably create capital flight into a market like the US, into things like US Treasuries. Russell Napier says that he's long the 30-year Treasury, US government bond, and also means that it will give our central bank room to cut rates even more, right? Because think about what's happening. As those other countries are experiencing capital flight and their central banks are slashing rates and doing all kinds of crazy policies to try and keep their economy on track, what will happen is their currency will go down, the US dollar will go up, and all the things that we import from around the world will get cheaper. And so the Federal Reserve will be looking at inflation data, and the inflation numbers will go even lower than the 2% target that we're missing. And so then the Fed will step on the gas even more. Okay, that's how that scenario looks in general. And it's not unprecedented. This is basically what happened in 1997. In 1997, there was the Asian crisis. The US didn't have a crisis, okay, but Asia had a crisis, which started with the Thai baht peg being broken. I don't want to get too into all the mechanisms of what happened in that crisis, but basically it was disinflationary for the US for exactly a scenario that I just laid out, and it caused Greenspan to put his foot on the gas from a monetary policy perspective. And our stock market took off, right? That was a deflationary effect for the US, and the response from the Federal Reserve had the effect of having asset prices really run. Europe now has a bank resolution and recovery mechanism, which basically means that some large depositors could face a capital loss if the bank goes bust. Okay, so this is going to make people with a lot of money run from those jurisdictions that are having problems, and the US will be the benefit of that. So it all sounds very deflationary, and that's why Russell Napier says he's long a 30-year bond. Now the question is, what will the response be? And the interviewer asked the question about modern monetary theory. He thinks that somewhere along the line we're going to get something like that. Sounds like Russell generally agrees. The response to this crisis, if it happens, will be very inflationary. Each bust since 1998, our economy here in the US has flirted with deflation. Okay, we've either experienced a decrease in prices or inflation has dropped very significantly. Modern monetary theory, he points out, is potent, debilitating, very hard to stop. Okay, and it really changes 20 to 30 years of the environment that we've been in. We'll get the disease first, which is what he's talking about, the likelihood of a banking crisis, and then we'll get the cure. The cure meaning MMT or MMT-like policies, which are extreme policies with no history of success. And the issue is that for something like MMT is that it will be necessary to inflate away the debt. Forget about whatever the politicians are going to tell you the point is. The point is that the debt needs to be inflated away. It won't be the reason that it won't be the reasons why they're selling it to you. Okay, we will have to have a period of time where nominal GDP is above interest rates and inflation levels are above interest rates. Now, if that happens, there'll be a great incentive for everyone to borrow money because interest rates will be below inflation and GDP. So he speculates further that the government will have to come in and control prices. It'll control the price of the long bond, of 20 or 30-year treasury bonds, and also will probably try to control bank balance sheets because of this huge demand that comes to lend. So to recap here, what I think are the major points. For 25 years, Napier has been writing about the risk of deflation, okay? And what he is speculating is a final deflationary shock that will come from outside the US, either from Europe or China, and that'll be very bullish for asset prices here in the US. And then Europe or China will start printing money, and China with the flexible exchange rate. Now, I would make the point that when we get this kind of regime change, okay, meaning that things have operated in a certain way, different asset classes have operated with a certain relationship to each other for 20 or 30 years. Okay, the standard 60-40 portfolio, 60% stocks, 40% bonds, are not perfectly correlated and have both done very well. And having a portfolio with just those two assets has done incredibly well for 20 or 30 plus years. Okay, but if you held that portfolio in the 70s, it would have been a pretty lousy portfolio. Okay, because we were in a different kind of world. And we will almost certainly be in a different kind of world in the next 30 or 40 years than we've had in the last 30 or 40 years. So when you make adjustments to your portfolio, broadly speaking, you have to do it with a deeper understanding of what's actually going on, okay? Not just looking through the rearview mirror. As Napier says, quote, I'm quoting him on this, when they change the rules of the game, we have to think twice about playing the same game we were playing before. And the whole point about changing the rules will be to inflate away the debt. He speculates, which I find totally plausible, that the US and China will enter a Cold War. And if that happens, the Chinese RMB peg to the US dollar won't last. It doesn't make sense to use the monetary policy of your enemy. Okay, that's really, if you think about what someone who pegs their currency to the US dollar does, is that they're basically using the same policy, the same monetary policy that the US does. Anyone who pegs their currency to the US dollar ends up effectively importing the monetary policy of what the US Federal Reserve does. Okay, and so if the US and China are in a Cold War, why would China use the monetary policy of its enemy? And that Chinese exchange rate is a critical issue for investors. He thinks it won't last much longer. And so, this is an issue we've talked about, and it's obviously critical. Please subscribe. Don't forget to hit that bell next to the subscribe button so you'll be notified when I make a new comment. Thanks for listening.